Maritime insurance is a hidden part of our global economy. It is the financial safety net that supports world trade. It protects the ships that carry goods between countries. It also protects the valuable cargo inside them. Without this protection, businesses would be afraid to send their products across the oceans. The risk of loss from storms, accidents, theft can be devastating. This insurance helps keep the flow of goods moving smoothly. It allows companies to trade with confidence, knowing losses will be compensated. The clothes we wear, the electronics we use, the food we eat. Maritime insurance helps keep prices stable and supply chains functioning. However, geopolitical storms are brewing, making shipping riskier and insurance more expensive. So we must ask, can maritime insurance withstand these powerful, unpredictable pressures? To understand the challenges, we must first understand how maritime insurance works. At its core, it is a system for managing risk. A ship owner buys an insurance policy. A cargo owner buys a policy. The policy promises to pay for specific losses or damages. The owner pays a premium, contributing to a shared pool of money. Insurers collect premiums from many clients to spread risk. When a loss occurs, the owner files a claim. The insurer investigates coverage. If valid, payment comes from the pool. Insurers must collect enough to cover expected claims, costs, and profit. They price using ship age, cargo nature, route, and operator safety record. Historical accidents, weather, and piracy data feed the models. But sudden large-scale shocks can deplete funds and strain the model itself. The world today is marked by rising geopolitical tensions across many regions. International relationships strain as nations compete for influence and resources and control of strategic choke points. The oceans, highways of commerce, become arenas for dispute. A route once safe can become high risk overnight. Ships face being stopped, inspected, even seized. Insurers must reconsider coverage and pricing in real time. Tariffs, sanctions, and blockades reshape trade rules quickly. Ship owners and insurers must avoid sanctioned entities and routes or face severe penalties. All of this creates a more volatile, less predictable environment for shipping. Risks now extend beyond weather and mechanical failure to politics, conflict, and intentional disruption. For an industry built on pricing risk, new tools and new thinking are essential. The calm seas of predictable trade have become choppy waters of geopolitical uncertainty, a fundamental shift. Military conflict is the most extreme form of geopolitical tension. When war breaks out, danger to ships, cargo, and crew rises sharply. Ports can be bombed or blockaded, sea lanes can fill with warships and mines, commercial vessels can be misidentified or attacked. Consequences can be catastrophic. Total loss of ship, cargo, and even life. Standard marine policies exclude war. Separate war risk insurance is required. High-risk regions are designated as listed areas with expensive additional premiums. In the Black Sea conflict, premiums skyrocketed and some insurers stopped offering cover. Trade reacted immediately. Costs soared, ships avoided the area, and global food supplies were disrupted. A larger naval war could hit multiple choke points at once. Potential losses could exceed market capacity, forcing government guarantees and state backstops. This is the nightmare scenario, revealing the limits of private insurance. Sanctions and blockades, navigating a maze of rules. Geopolitical tension creates complex legal and regulatory challenges. Insurers must follow sanctions regimes, especially in the United States and Europe. Coverage for sanctioned trade is forbidden. Violations risk enormous fines, prosecution, and reputational damage, so companies grow extremely cautious. Heavy investments in screening and due diligence are required. Insurers request more information, exact cargo nature, all parties involved and the shipment's final destination. Ambiguity can mean delays or no coverage at all. Rules can change mid-voyage, creating acute uncertainty. This political, non-physical risk still carries severe financial consequences. Managing sanctions risk has become a core competency for maritime insurers. Piracy remains a persistent threat on the high seas. It is a modern, adaptable criminal enterprise. Targets include onboard robbery, cargo theft, and kidnapping for ransom. Beyond fear, costs mount across the industry. Hotspots shift over time, Somalia then the Gulf of Guinea, with more violent kidnappings. Insurers designate high-risk areas and apply additional premiums. They encourage or require measures, corridors, speed, lookouts, barriers like razor wire. Some ships detour, burning more fuel and time. Private security adds another major expense. Costs flow down the chain, from carriers to cargo owners to consumers. Piracy is not only a seafarer's problem, it drags on global trade. Beyond warships and pirate boats, two less visible forces redefine risk: cyber attacks and climate change. Ships are floating computer networks, navigation, communications, engines, cargo systems. A cyber attack could ground a ship, cause collisions, or leave it adrift. Ports are targets too. Shutdowns trigger logistical chaos. Motives range from extortion to state-sponsored disruption. Pricing cyber risk is hard, limited data, and one event can hit many ships. Climate change means more extreme, less predictable weather, raising damage and total loss risk. Rising seas and surges can disrupt major ports for months. Shorter Arctic routes emerge, but with ice risks and sparse rescue cover. Insurers must develop new models for systemic correlated risks. Cyber and climate push the industry beyond traditional playbooks. Rising tensions directly increase the cost of shipping. Higher costs ripple through the global economy to everyday prices. Since most trade moves by sea, small cost shifts matter. War risk and piracy premiums can add tens or hundreds of thousands per voyage. Ship owners pass costs into freight rates. Cargo owners absorb them, then pass them to consumers. Rerouting adds thousands of miles, burns more fuel, lengthens voyages, and ties up capacity. Uncertainty disrupts inventory and production planning. Firms hold more stock, locking capital and raising storage costs. In extreme cases, shortages emerge, seen during COVID-19 and in localized geopolitical bottlenecks. In the end, everyone pays more when the seas grow riskier. Maritime insurance can survive, but not by standing still. The industry must adapt, innovate, and collaborate. First, embrace data and technology for real-time risk assessment. Fuse satellite tracking, weather models, and political risk intelligence to build dynamic risk pictures. Price precisely. Reward safer operators and routes. Warn clients of emerging dangers in real time. Ship owners should invest in navigation tech and stronger cyber defenses. Second, focus on loss prevention. Make safety profitable via premium discounts. Invest in people, maintenance, and security measures. Finally, stronger public-private partnerships for outsized risks. States can secure sea lanes, clarify rules, and act as reinsurer of last resort to stabilize trade. Will maritime insurance weather today's geopolitical storm? The answer is a conditional yes. This industry has capacity, tools, and a history of adaptation. It has weathered wars and the rise of modern piracy. But survival demands change, smarter, more cautious, more tech-driven. It will be more intertwined with governments and global politics. Expect higher costs and more restrictions in some regions. Invest in data and technology to understand and price emerging risks like cyber. Be ready to refuse coverage when risks are too great or uncertain. Success is collective: insurers, ship owners, and governments together. Invest in expertise and resilience. Uphold international law. Secure vital sea lanes. The free flow of goods underpins prosperity. By acting together, we keep the shield intact so trade can weather this storm and those yet to come.